today we are going to learn technical analysis and we are going to use it on synthetic. And now, before now, I told you guys that the thing that differentiates synthetic pairs from the forex pairs is that it's like a derived version. It's not even like, it's a derived version of forex pairs. It's like it is mapped after forex pairs. So let's say the people who made it, I think what they did is they study how the forex and stock market moves, and they map some derivatives of them, giving them a different name. Now, the advantage of this is that since it's not the real forex pair, it is not affected by news. It is also not affected by your sentiment. It is not affected by news, not affected by your sentiments. Scalping King, yeah, no. I have Vex for waiting now. I know Vex. This is synthetic, all right. So it is not affected by news. It is not affected by sentiment, which means your biggest cue in synthetic trading is how good your technical analysis is. So, like I said, I said something at the beginning of this whole lesson, and I said that I almost gave up on forex. Okay, I almost gave up on forex until I saw someone who trades mainly synthetic. All right, and he was getting it clear, and I was like, okay. I mean, it wasn't like my technical analysis was bad in the forex. I just had psychological problem where I make some mistakes and I don't follow my rules. And one of the reasons why it is so difficult to follow your rules in the forex market is because there are so many conditions that are involved. All right, there are so many conditions that are involved when you are trading the forex market. One of those conditions is you may have done your technical analysis right now, and the next thing you see is that fundamental activity going on, and your technical analysis just goes to shit. But for synthetic, you can do an analysis, and if your analysis is correct, just know that it is going to go. That is the beauty of synthetic. It is unlike the forex market, where yes, though your analysis is correct, if the market wants to do you dirty, it's still going to do you dirty. All right, which means that if you perfect your technical analysis, you are going to have a very good trading experience with synthetics. Also, another added advantage is that you can trade it at any time. The market is never closed unless there is like something going on with the particular broker that you are using, or actually the particular liquidity provider that your broker is using. You know, the brokers, they have liquidity providers, right? So your particular liquidity provider might be having an issue, and then that is the only thing that I have experienced that caused a downtime or during the time that I've been trading synthetic on the reef. Okay, and the sites to use for that, because synthetic pairs are not available in the forex environment, so most forex brokers does not offer synthetic, so you cannot find synthetic on Exines or most of the common brokers that you are used to. The king of them all for synthetic is the reef. All right, I think there was a time that there was synthetic in one prop firm that Habib FX was advertising back then, and I'm not sure if that prop firm is still available, but they also have synthetic prop firms for those of you who are prop firms fanatics. Okay, they also have synthetic prop firm, but it's not that popular. Okay, so now, and that is the reason why the first thing that I want to start you guys with is technical analysis. Most of you call yourself traders, but you don't know what type of trader you are, or you don't even know the type of analysis that you are doing. Your own is you want to come to the market and just trade. If you want to call yourself a trader, you need to understand what type of trader you are. What is technical analysis in the first place? Technical analysis is the ability of a trader to study the previous or the historical price action and learn from the price movement, thereby using that information to predict future occurrences of the same price action. So you study what the market has done in the past. So when the market breaks below like this, what did it do? So for example, what happens before you see a big move? So okay, if after a big move you always see a retracement, that is technical analysis. So what happened after an explosive move? You always see that after some explosive move, something like this, right? You always see after an explosive move there is a retracement and then there is a continuation, right? So you use this particular idea, you study how it does and how that pair does its own, because different pairs, different price movement, right? So you study that pair and then you try to use that information to predict your next, or should I say your future price movement. So what you have seen before, the last time you did this is what happened. So this time you are doing it again, so I am going to take advantage of it. That is what technical analysis is. You study the historical price action and you use it as a base for your prediction of the next price action, right? Is that clear? I try to take my time to explain everything. Is that clear? Okay, so if that is clear, moving on. What if studying historical price action is what technical analysis is, then the first thing that a technical analyst should do when it gets to the chart is to first of all get familiar with what had happened in the past, because it's literally in the definition of your name, right? So first thing you have to do as a technical analyst any day that you are about to begin your trading journey, remember, information can change overnight. So the information you had about the trade yesterday, for example, you had a bias of buy yesterday, does not mean you are going to stick to buys. You know, your overview analysis first, you look at the historical price movement to get the information of what the market is doing currently, because from studying the history you can follow the price movement. And remember, I was saying this before, take the market as a driver, all right, and you as the passenger. Take the market as a driver and you as the passenger. You can be a good technical analyst, that means you are a good passenger. It does not make you a competitor to the driver. Okay, so the market is the one driving. You as the trader, you are only a passenger. Okay, so all as a passenger you cannot go and take the steering. You sit in the car, and if possible the best you can do is, hey driver, please, so slow down. That's all you can say. All right, exactly. We will get to that, Kia. We will get to that. We get to that. Don't rush. We are getting to that. Okay. Ask questions that are related to what we are doing now. As we are progressing, you can ask the more advanced questions. Okay. Keep your questions tailored to what we are doing now, so that everybody can follow along. Because if I keep jumping from front to back and back to front, a lot of people are going to get lost. Okay. Just give me time. So now, as a technical analyst, what you want to do, the first thing that you will do when you get to your chart, and again, we're talking about why. Okay, sorry, I was at the driver story, Abby. So I see yourself as a passenger in the car, not the driver. You don't want to drive to you don't want to what is it called? You don't want to drag the steering with the driver. You guys will end up dying. What you want to do is you come to your chart and you enter the car, you stay, and you don't want to get into the car too early. And I use that example of those guys who enter along, or those guys who have entered public transport before. You would agree with me that if you enter public transport, one of the worst thing, or one of the worst conditions to be, is to be the first person that enters the car, because the driver is definitely not going to go. He's going to wait until the car is full, until he knows that he's what's it called? Until he knows that he's going to make his fuel money back. He's not going to go, right? You guys will agree with me on that one. So the forex, if the forex is the driver, then know that it's definitely going to, like, go back for liquidity, go back for passengers. Call liquidity your passengers, or the passengers of the driver. And that is what you get in mind when you are approaching your analysis on the synthetic pairs. Since it is purely technical, you don't have to worry about fundamental, and you don't have to worry about sentimental. It means that you can just be patient and be the last passenger in this driver's car, instead of entering the car abruptly and then staying in drawdown, hoping that the market goes your way. And how do you approach the market when you are trying to analyze as a technical analyst, right? First of all, you want to avoid the 1 minute and the 5, the lower time frame. Generally, you want to avoid it when you are doing your analysis. the lower time frame is not your friend when you are doing your analysis. Why? Because there is a lot of noise. But you see, this noise will come handy later, because it is this noise that speaks the story of how you get your precise entry. You can say, I have not even done an analysis and I know that this was a very good trade. If I was here, I probably would have taken this. My eye just caught this. Now, even without any analysis or anything, I can just draw the line and, you know, tell you why this trade was a good trade to take. And you see how the entry is now. The reason why you were able to stay out of it until you are the last person inside, it is because you do your analysis. And that is where all this lower time frame is going to come in handy. But to get the overview, to get the complete story of what the market is about to say, you need to look at it from a broader point of view, like from a wider point of view. And that wider point of view is time frames that have little to no noise. What you are considering noise on the lower time frame is not seen in the higher time frame, which means you can get a better view of where you expect the market to actually go. Because if you are staying on the 1 minute, you can get like 5 entries in just one small price movement. If you switch to let's say I switch to the 1 minute right now, and let's say I draw a box around just this area, right? I draw this box around this so we're going to look into this area. This whole thing that doesn't make sense on the 15 minutes time frame until we got to the entry. If I go back down to 1 minute, you see that there were like 70 to 80 opportunities in that box. Now the question is, do you want to be taking all the opportunities you see? It seems like I've gone way too far. Okay, I think I've loaded too much information, so I cannot go too far back in time. Okay, I cannot go too far back in time, but you get the point. You get fake outs. You get a lot of let me actually, I really want to do that thing. So let me look for a closer price action. So for example, everybody would have stayed out. Yeah, everybody would have stayed out of this particular box, right? Because on the 15 minutes, it's not looking too good. But if you go down to the 1 minute, what do you see? If you have seen more than 20 trading opportunity inside this box alone. So that is the noise we are talking about. Look, there is so much up and downs inside this box. Something that on the 15-minute time frame, you decided to stay out of it. But now that you are in the 1 minute time frame, someone here would have said, this is a break of structure, or this is a break of structure sell, this is a break of structure buy. You know, you keep taking a lot of unnecessary trades that might end up not being too healthy for your account, right? You want to get into something that you trust, and having a higher time frame directional bias is better. Okay, so instead of use the 1 minute and the 5 minute as your entry time frames, but to do your analysis, it is always advised to look at it from a bigger time frame. And the way I approach the market is, if I let's say I had this trade going on, and today I want to come back to the market. Yeah, so yesterday I was able to catch this trade, right? Now I took it out here, so let me put it there. I caught this trade. Today I opened the market. Probably the market is going to look like this. What many people do is they quickly rush and go and check where the market is and start looking. Some people will just come here. They're on the 5 minute too. They don't care. They're now looking for where is the entry. They just start looking. Okay, it's going buy or it's going sell. That is not how to do an analysis. What you want to do is, in fact, avoid where the market is now. Run to the higher time frame. If I have a lot of time, or if I have not stayed away from that particular pair for long, I will not bother going to the 4 hour. If it is a pair that I've been trading, let's say the previous day, the day before, which means I am in line with what the market is doing, then I don't need to waste my time and go to the 4 hour time frame. That would only mean that I already understand what the market is doing, so I am still in the story. But let's say I just go randomly. Let's say this is not V75, and let's say I go randomly and I go to volatility 10 index, for example, and I want to analyze this pair. I cannot just come into this pair on my 15 minutes because I don't have the overview. So this is when I would definitely need to go back to the 4 hour to go and start my analysis. But in cases like, let's say it's a pair that I analyzed the previous day, like this, let's say this V751S that I've been through the week, I can just come here and I'll just start my analysis on the 15-minute time frame. Okay, because I am still in the moment. I know the entire story that the market have been telling me, and I'm following the market. So what I do instead, if I am seeing a completely new chart or a chart that I've stayed away for more than a week, I will definitely go on the 4 hour. And I want to assume that that is what we are doing today. So let's just assume that this is a pair that none of us have seen in a long time. So we are coming. What I will do is I will go to the 4 hour, right? And when I go to the 4 hour, the next thing I will do is to zoom out completely, zoom out like this, so that I'll see a bigger picture. Overall, you can see that the market has been breaking lower lows, right? Breaking lower lows, then breaking lower lows. So ideally, you can just say that this market is more of a downtrend, right? And after there is a break, what do you expect originally after a break? Yeah, please help me to share, to like, to tap, and let's bring this up. At least that is all I ask from you. I'm not asking you to pay any money. I'm not asking you for any other favor. Let's make this thing go far. You guys encourage me, and now I am ready to deliver it. So let's not make it boring now, shall we? So now that I know that on my 4 hour I'm seeing breaks to the downside, I'm more than happy to look for sales. Okay, what site are you talking about? For volatility pairs, I trade on Deriv. So if you want to get the link, go to the Telegram group. You'll see it pinned up there. Register an account on Deriv. And I've already told you guys the importance of synthetic. They are available on the weekends, and you can see we are in the weekend right now. So a forex trader would think there's nothing else to do in the market. Meanwhile, for us, this is just the beginning of the week, because actually I trade more Deriv pairs. Okay, so we are back. Sorry about that. For those who have been asking for the link that is not working, it should be working right now. So let's get back to it. I don't want to stay long today. So now we are on the 4 hour, and we want to begin our technical analysis. We already have our own set of rules. First thing is, what has the market done? We are going downward. Fine. So if I'm looking for sales, the first thing I will do is, where has the market broken to? And has the market started retracing? I'm always waiting for retracement to get involved. Now that you know that all you have to do as a passenger is to look for a good entry, you now know the direction that the market is going. So all you should be looking for is, where should I get in? So now, let's say, for example, I want to get into a trade based on the 4 hour. I cannot just be here and then start looking for sales simply because I know that the market is going down. Instead, I will have to wait for the market to do a retracement to at least my 50%. And remember, the 50% is the thing. And now, to answer that guy, was it 12? Somebody said, how do I use my Fib? Right? Now, I hope you're scared. The person that asked how I use my Fib. And I told you a fees. I hope you are still here. Okay, so this is my Fib, and I made this simple. I made it this simple because I feel like it doesn't have to be complicated. If you notice me, I have said it clearly before that I feel like I am a very dumb person. So I like to simplify my things a lot. And that is why you see me using our real life examples when I'm explaining chart analysis to you. It's not because I don't know how to use all those big words, but what is the point? The point is to make money, is not to come and speak English. You understand? So now I make this one too simple, right? I make this one too simple. This is my Fibonacci. And if I check, you see that I only have 0, 1, and 0.5 on. 0.5 being the midpoint, which is like 50%, right? That is all. And then I make everything, the color is black, just black, 61%. I can actually even make that 100. That is just the only thing that I touch. All right, that's the only thing that I touch. I don't touch any other thing else. I just make my lines black and 0, and then I uncheck every other thing. Every other thing on my chart is unchecked. And then you see the levels are on. It is set to values. And then you see text. It is set to center, middle, label, center, middle, font size 10, just so it's that simple. So it is the compact mode, just so it is very, very simple and easy to read, right? So the next thing is, you can see that is why it is this clean. because there is only one thing that I'm using it for. I want to see that every retracement, yeah, Fib is 0, 0.5, and 1. That is correct. I want to see that thank you so much, Maverick. I want to see that every retracement has like a pullback to at least the 50%. That's the first one. So we are on the 4 hours now. The first thing that I see is, I ask myself is, in the current market condition, remember the time frame that you are on, in the current market condition, what do you see? First, I see a break here. But before the break, I see something that I would have considered a break before, which then turned to become liquidity, right? So what do you expect when the market break originally? When the market breaks to a certain direction or breaks to another direction, one of the things that we look for is a retracement, right? And we hope for this. This is what SMC traders will call order block, right? Let me zoom in. I'm just looking at the 4 hour now. I'm not going into any time frame. But based on this 4 hour now, what do you think? What are you looking for? If there is a break, an SMC trader will be looking for a retracement to the order block, or what they call the OB, right? Or the points of interest, whatever, preferably from the body. Abi? That is how it is done. Which means you expect this low to hold at this point where you are considering this as a break. At that point, here will be your protected low. At that point, protected low. It's protected low because it has broken structure to the upside and you don't expect it to be violated anymore. So violating it, and that is one thing that I said, if you guys remember the last time we were on live, I think it should be yesterday, I said that losing a trade also is a sign for the next trade. So if I take one loss, it's not a place to be angry. It's a place it's like a confirmation that, okay, maybe the direction that I was have just been violated. I'm in the wrong direction. And it will help you to get yourself out of these shackles of saying that my bias is buy, so I'm not going to take a sell. I keep hearing people saying that thing, he's going to buy. Who are you? You are not the driver. And as a matter of fact, there is no way you know how to drive and you do mindset of the driver, correct? If you have that in mind, then you should be fluid with your bias. You can have a buy bias simply because you did your analysis. And yes, if you are here, by the time this thing was still break of structure, looking for a buy from this area is a good thing, okay? But now that it came, it have returned. Look, there is something internal here. You can see this is the decisional. If this market really wanted to respect this low, after coming this close and tapping into it, you see, it tapped into this zone, right? And going back, there is nothing that is looking for back here anymore. You notice something, that when this market wants to go up and it break up, it didn't go below this one. So having this market break below this area is already a violation, right? Thank you guys for all the gifts, man. Thank you guys for all the gifts. I appreciate you all. Maverick, you are the real MVP. Game Boy, real MVP. All of you, Fashion, real MVP. So yeah, change of character. Thank you very much. Changed character, or what I like to call shift. The moment a protected low is broken, I call it a shift. Not shit, a shift. I rename it to shift. And I said something earlier, right? That as a good technical analyst, you need to be proud of your abilities. You need to get this. I like to see my trade being clean and labeled. So for example, if you know how I trade, you should only have to take a glance at my chart to know what I am looking at, or you should, just by looking at my chart, you should be able to, read my thought process as to how I got that analysis. I don't need to even explain to you. That is, if you have been following me for some time already, if you see this shift, you know why the shift is there. And that is why you see me labeling everything that I see on my chart. It also, because look at that word now, technical analysis. Come on, man. You need to be proud of it. You need to make your chart look presentable. It might not mean anything to you, but things that are clean are very attractive to me. It helps me to stay in the market. That is just me for you. I like everything clean. So anytime I see, for example, it was break of structure before, now that it has shifted, immediately I will go and edit this one to become liquidity, because that place have been used as liquidity for the market to choose a new direction. All right. So this becomes the market structure shift. Thank you, Fashion. This becomes the market structure shift. And after a market structure shift, what do you see? I see an expansion, a very bold expansion, right? So after an expansion, what do you expect? A retracement, right? A retracement and then a continuation, because you now know that this right here is the direction of the market. This right here is not the direction of the market. You are no longer looking for bias because the top has been violated. Okay, and this is the 4 hour. Remember, we are still in the 4 hour. You can see how much time I'm spending on the 4 hour, simply because I want to make sure I get it right at the 4 hour, because it is a higher time frame that is going to be the decisional time frame for whatever the market is going to do. So if you're on the higher time frame, don't rush, don't think the market might be moving. It doesn't matter. Get your stories right and you'll get the best of trades. That is just my policy. So now that I've spent this much time on the higher time frame, I'm still here anyways. The next thing is, after I see this very intentional break, or should I say change or shift, and I see this perfect extension, what do I expect next? You guys who have been following me will already understand what to expect next. What to expect next is a retracement, of course, and to do a retracement, we also have a supporting rule for it. In our own trading style, we use the Fib extension, right? You take the Fib, you draw your Fib, and then what you are expecting for a retracement, yeah, it is being recorded, Adam, it is being recorded. What you are expecting from a retracement is at least a 50%. You see how I said at least? It is not a rigid number. So some people might want it to get to the premium, especially the SMC people. When there is a break of structure or a change of character, they expect the market to come to their premium, like their order block, or what they call OB. That is why I had this thing drawn out there. So an SMC person will have a box surrounding this last blue candle before the break, which is very correct. The market do often go to that area. But what I have found is that it doesn't have to go to that area. Doesn't have to go to that area. A 50% retracement is a good enough retracement. If the market wants to do a market continuation, it will just continue from there. And remember, the market always leaves liquidity behind. Just like it's going to take liquidity, it's also generating future liquidity. So for example, if the market does not leave this space, if the market does not leave this entire space in the open, how do you now expect to have a liquidity to target later in the future when the market is coming back? You see all those things that we used to draw as order block, right? All those things that we used to draw at the bottom, we say order block. You call this one order block, and then you are, maybe somebody out here now is saying, okay, this is a break of structure to the outside, right? And originally, what the general market always teaches us is that you are now waiting for the order block, right? If it doesn't leave this liquidity behind, how would you have an order block to target? So the 50% always work. If once the market has retraced to beyond your 50%, I think you are in like a discount or a premium environment where you can now start looking to take a trade. But just because the market gets to the 50% does not mean you are going to enter, right? And that is where that story of being the passenger and not the driver originated from. Because if you pay attention to the life of a driver will always want to get his car filled up before going, especially those who have entered public transport before. Have you ever gone to a public transport station and you are the only one in the car, and they will now say, okay, we are going? No, they will wait for the car to get full. And sometimes if the car does not even at the back, the driver will now beg you and tell you, you see, you people are only 8. The box is supposed to be 18 people. So please allow me to cycle around to go and get more people. You see those people that the driver is going to get in the forex market, those are what I consider as liquidity. So liquidity are the remaining passengers that the driver needs to fuel the movement to where you expect it to go to. And that is where this story of a driver and a loan comes into play. Me saying all those things, it does not mean that I don't have like big words to use, but I feel like if I relate it to something in my environment, it helps me to understand what the market is telling me better. So now, after the market have broken down, what I do is I just draw my Fibonacci extension. All right, I draw my Fibonacci extension, and just so my chart is not too complicated, right? I take the Fibonacci extension out and I just draw a line to represent my 50%, and I label it as 50%. So if the market is approaching it, when I have this line, I'm not going to be confused as I'm not going to take this one and be confused and say this is the liquidity and I'll start selling. So yes, this is 50%. The next thing you want to see is after 50%, you should at least target the nearest liquidity above or below that 50%. And then that is the reason why I have this line here based on this 4-hour now, right? So this is the nearest liquidity. So this is where the passengers are holding. Now, another way to explain liquidity is that liquidity are all the places where some people have their own stop losses. So for example, that guy who is taking a trade based on this confirmation, based on this bearish candle, he probably have his stop loss above this candle, right? Above this particular candle. And maybe he's foolish enough to be shooting for the moon because, you know, he's looking for the market to get to the other block, right? So now the person who has a trade or who has an entry in this place probably have his stop loss above this area. But what do you see? This particular reaction happened before the shift originally happened. Yes, it is. So this particular reaction happened before the shift happened, which means it is the liquidity contained in the entire move. Remember, when you are taking an extension, you are taking it from the top, which means you are having this entire move here. You are having this entire move here. You are putting it into. So this person has a stop loss here, and that is why we call it liquidity. So that's another explanation for liquidity, right? You are coming to get some more fuel so that you can, you know, go ahead to go down. How much for a physical class? Except if you can visit me in my house, because I don't have like a physical academy yet. It's still in the works. Okay, very soon it might come in play, and definitely you people should expect that it's going to come up. I'm just getting started yet, and I like the fact that you people are enjoying what you are seeing, and thank you for all the encouragement. I'm definitely going to get it. I stay in Abuja. So for those of you who would like to connect, I'm in Abuja. All right, please, let's get back to it. Okay, so that the recording will not be too long. I'm going to upload this thing on Addicted and Unfiltered. All right, unedited and unfiltered. Watching from Zimbabwe and totally glued to the lecture. Thank you so much. Thank you so much. So let's get back to it. So now we have established what we are looking for. I can just delete this Fibonacci retracement. And now I know where, first of all, I would like my market to get to beyond 50%. Secondly, I would like it to take liquidity before I can even be interested in taking, you know, any trade, right? And what do you see here? There is a liquidity grab there, right? And this is the story. So just by seeing this shift, I know that what I'm looking for, my expectation is in a retracement, and then I now map out my retracement level. Now that I have all that in the bag, the next thing is for me to wait. Let's say, for example, I came into this market and the market was just around here. It means it has shifted. Instead of just entering the trade and say, oh, the market is selling, some people will just see this candle, oh, bearish candle, and then they will just go and enter, they put their stop here. And that is why we call them liquidity, right? Because the person that is paying attention to only this candle on the 4-hour will have a stop loss above here. The person that took this one will have a stop loss above here. So there is a lot of liquidity resting internally in the internal structure, and all of them are probably too greedy. So they are targeting this low, right? Because that's what they are seeing. They are targeting this low. So before the market goes there, as the driver is like, oh, I don't get enough fuel, and many people never enter this my car. Let me go back and take more people. That is what you see here. It comes back. It goes beyond the 50%. Take out liquidity. It is now when the market has taken liquidity that you now should be getting prepared to get into the class. So all these are preparatory analysis. It's a lot of time because I have to be explaining, but trust me, if you know what you are doing, within 30 minutes or 15 minutes, you should be done. But I encourage you to spend a lot of time, okay? I encourage you to spend a lot of time. Try to understand exactly what had happened before what is happening, so that you have a better understanding of what you are looking for. Okay, that will help you to get a better projection. So now that the market have retraced back to the 50% and I am ready to trade, the next thing that I now need, this is now when I will now switch down to my lower time frame, okay? So I can take a brief look at the 1 hour, but oftentimes the 1 hour is almost saying the same thing as the 4 hour, just in a little more details. The problem about having too much details is that it gets confusing, right? Too much details can get confusing because it speaks a lot. When you are going to the downtrend, if you don't have like a higher time frame bias, the internal structures are going to confuse you. So for example, when this market is coming here, somebody is looking for sales here, probably because this one is another break of structure. Somebody is looking for sales here. Another person is also taking a new trade here. So there are two forms of liquidity that can be taken in the internal structure. The one that is taken as the market is coming back, or the one that is resting above those who are already in a successful trade. So for example, this person is here, is in a trade, his stop loss is here, right? He is shooting for the moon. So we are going to take him out. This person is also here. This person is also here. His stop loss is sitting above this one. He's targeting this low, and we are going to take him out. So once reversal starts, the market is going to take these two people out. Those are the first set of liquidity. The second set of liquidity are those ones who are buying or selling at every reaction point without paying attention to all that we just did. So if you have done your due diligence, of course, you know that you are not supposed to take a trade here, even though it's giving you too much signs. All right. Even though it's giving you too much signs, you know that you are not supposed to take a trade here. So you would have avoided this one. So yeah, the third type of liquidity will be that person who is taking this trade because he felt like this was a break of structure. This was a break of structure, but he's failing to understand that all this, let me delete that. He's failing to understand that all this that you are seeing now, these are internal structures. Okay. So let me annotate that and let me delete this one. You now understand how liquidity is built and how liquidity is taken. So as the market is coming back, one hush puppy is buying or selling at this point, looking for the market to drive down. Liquidity, it's going to induce you, and that is why you see the market doing all these things that it's doing. Because remember, for the market to struggle past here, it means there were a lot of orders here. So it should not be surprised when you see a reaction in that environment, and that reaction can be seen as inducement. Inducement is when the market is doing as if it's going to give you what you want, right? But then goes ahead to take you out. So it gives you a test of profit, because if you entered here, you would have been in profit for like 1-to-1, right? It gave you like 1-to-1 and then went back against you. So at that point, you are feeling very confident. Some people might even already be making a lot of mouth in their various groups and be saying, "Oh, more, I caught a trade, I caught a trade." Some people are even scaling in. So now it gives you that inducement and then it takes you out. That is the third type of liquidity that is taken. So more passengers are getting into the car. You're welcome. And then it takes this guy out too, because you did not do your top-down analysis, so you did not know where to target or where to expect the market to get to. You say, okay, this is your 50%, and then you now enter a trade. Like you enter a trade like here, because you are sorry. You enter a trade like here, you are the number 2 liquidity. Maybe you enter a trade after this reaction. You have your stop loss right above that liquidity, and then you are also targeting this low. So liquidity, the driver, which is the market, it took liquidity here, it took liquidity here, it took liquidity here, and now it has taken liquidity here. Remember again, as it's coming back down, some mumu is saying, okay, because it has violated this area, or it has violated this area, another person is now sitting here, setting his buy here, right? Liquidity number 3, and these are the ones that we get in and we target. These are the people who are paying for our money, the money that we are making. So the ones who are fighting us after we have achieved our goal, those are the people that we are now going to face now. So liquidity is always going to be available at above or below every structure. So now you see how the market moves, right? And that is why it is not surprising that it came here, it reacted to it, again inducing other people in, making them to feel proud that they have a very big trade. I'm sure the person who entered this trade here will be targeting at least 1 to 3. So his expectation will be above this area, correct? Which means after the market gave him this little sign, because he feels like he's in an uptrend, he is opening. When the market came back to tell him that get out, he's not listening. He's saying, okay, this is a retest. So probably he's entering another trade here again, right? He's entering more trades here because he feels like the trade has gone in his favor and he's targeting here. So he will not be moved by all the stories that the market is trying to tell him. All right, he will feel like he's in a good trade, and it keeps inducing you until boom, this is where we get in. You see, this type of candle is where we get in, because this is the intentional candle that I'm talking about. At this point, it gives you no, and you notice that when the market wants to move, have you ever seen, or have you ever witnessed this? When the market is about to move to take your stop loss, it doesn't give you an opportunity to close. As a matter of fact, the only opportunity that you are going to get is an opportunity to extend your stop loss. So, for example, this person who is here, because of how aggressive this is coming, is now deceiving himself. He say, okay, maybe his stop loss is right here before. Maybe his stop loss is right here before. He say, okay, maybe my stop loss is too close. Let me target here. The next one, some fools will even do something like this and say, oh, okay, maybe I entered too early. Let me put my stop loss here. This is how the market keep playing with your psychology, and you keep paying other people who understand what they are doing. You understand? So it will keep giving you signs that you might think it is the right sign at the right time, and if you don't understand the story the market is telling, you are going to fall a victim. So guys, there are 59 people in this chat. I have 38k view. If everybody gives me 1k, I should be at 59k view already. You guys are not trying, no. Are they trying now? Me, are they trying now? See as I dey shout, see as my voice they go. Are they beg now? Me una like now. Me una follow now. I'm just kidding. I appreciate everybody who has been liking for so long. And if you are getting any value from everything that I've been saying, the goal here is for us to have a community where we can interact and trade together. And that is why in most cases we trade live. Almost all my trade I take them live. Okay, all my trade I take them live. And if I don't post it here, if I'm not on live, I'm always posting it on the Twitter page. If you go to my Twitter page, you will see all the this is the last trade that we took, so you see all the progress step by step. When I'm entering, this is when I'm expecting, this is when I'm entering, right? This is after I've entered, this is how much I'm making, this is the analysis and everything. So you want to do yourself a favor, be on the Twitter. If signal is something that you are looking for, that is the place I post my signal. The reason I choose Twitter and the reason I have all these various places is because in Twitter I can easily update the trend, right? Is it trend or thread? I can easily update the thread with new information. For example, look, I say trade close here, right? If you notice, I created this one 7 hours ago, and then when I posted trade close, this was like around 10 a.m. today. So that's like after I closed, that is when I updated it. So if you have your notification set, you can follow everything that I'm doing and you will not be losing out. That's it. Let's get back to business, okay? Let's not go off topic. So please help me out. Jesus, 40k. You guys are the real MVPs. Thank you so much, okay? So I did this on purpose so that I can use it to explain to you when you are seeing some kind of stupid things on the market and your mind is hardened and you are thinking you are the boss of the market and you are getting too stuck. This is exactly what is happening. So for those of you who are taking out here, this is why you were taking out. For those of you who are taking out here and you see that is when you now start crying that the market took me out and it went my way. This is exactly what happens because you did not pay attention to that liquidity. You only pay attention to the fact that the market retraced to 50% and you just jumped in. There are other things that you need to put into consideration. And I had to come up with all this. For those of you who are asking me what trading strategy I'm using, or if I have like somebody who I learned it from or something, I think I learned most of the things that I know from a combination of strategies from different people. I've studied from people who trade support and resistance. I've studied SMC before. I've read The Alchemist. What's that one? I have followed Raja Banks. I have followed Donvo. I've followed DAX. I've followed many people who trade different strategies, and I've learned a thing or two from all of their strategy. I think the best thing is not to fight any strategy. Every strategy has a point. And just because your own mental capacity is not strong enough to understand what that strategy is saying does not make it a wrong strategy. You will never see me bashing anybody's strategy. Every strategy is a good strategy. So the point is to understand what the strategy is about. You see, I just did an analysis based on pure price action. If I want to be an SMC trader now, I can start giving you some big words like fair value gap. One, this is fair value gap. This is where an SMC trader will want to tap into. Abi, another one is order block. Those are those ones that are very premium with your those ones that don't want to lose any money at all. You see, that is order block. So I can use all these words, but does it help me explain or convey my message the way I want it? I like to simplify my things, and that is why you keep seeing me. That is why it feels shock, fair value gap, FG. So all of them, they make sense, but understand what it's trying to say. As you can see on my chart here, there is no single indicator, right? The only indicator you would have seen will be on my Forex pair, where it is the original trading view, which means I can put this indicator, and this indicator is just the sections, Asian section range. It's only showing me. You can see that I've even redesigned my own to make it look this simple. I just want it to be pointing out what section I am in. So if I'm seeing the section, I know I'm in London. This one is London. I think this one is Asian, this one is London, and the pale one, this one is New York. So this is the only reason why I have those indicators there, because I know that in the Forex market, the market is always going after the liquidity below or above some sections, right? So that is why I have them on. Apart from that, you will not see me using any indicators. All right. Asian section range. Asian section range. That's the name of the indicator, this particular one. But originally, I don't use indicators. And the reason for that is, it's not as if I am telling you that indicators are flooded. It's not as if I'm telling you that the indicators are bad. The thing is, if you have learned what the indicator is saying, then it doesn't need to be on your chart. For example, a moving average indicator is trying to tell you that this is where the average movement or the average price movement is. So if you are seeing it flip ahead, so a moving average indicator will be something like this. Now it will go like this, and then it will flip over here. So it's telling you that the market is changing direction. Understanding what the indicator is saying is all you need to do. So if you have used indicators in the past and you are just using it, okay, you have been using one indicator for 1 year, and you still need to have it on your chart before you see what the indicator is telling you, it means you are not learning the story that the indicator is telling you. So for me, I have most of these indicators in my head already because I have used them a couple of times. You see all those overbought, oversold, those beginnings that you see. One thing is, it makes the chart look complicated. It makes it look very messy. And I like I've said, you would notice that I like to keep my things simple and clean, neat, right? So having too many indicators on my chart are not going to be there. The one thing that you are going to see many a times on my own chart are these lines that you see there. And oftentimes you see me label them, you see me annotate them so that I know exactly what that line is telling me. So for example, this dollar sign, let me see if I can zoom in. You see, this dollar sign represents money in terms of like liquidity. Okay, so I don't need to type the entire liquidity there to understand. So if I see dollar sign, I know I'm talking about liquidity. Now, if I see shift, I already know I'm talking about change of structure. There are some times that you can see me write something like this, N3. That means entry. This is where I expect to enter the trade. You understand? So if you see N3 on my chart, it means entry. That is what I'm trying to say. And then 50%, that is to show you that if you see 50%, just look outward and try to see where is the beginning of that move that I have my 50% on. So anytime you are seeing 50% on my chart, that is to tell you that I have pulled up my Fibonacci extension and I have labeled that 50% right there just for visual representation. And just so I don't complicate my chart, I take out the real Fibonacci because it can be messy at times and it can come in the way of your analysis, right? So that is how I do it. I take out the 50% and I just drop an annotation. Then another thing you can see in my chart is B, which means break of structure, right? Break of structure to the downside. So if you see B, I'm trying to signify break of structure. If you see B changing to S, that means it was a break of structure and I was expecting a retest, but as soon as it shifted and it was validated, it turns liquidity. So it was taken for liquidity, structure was broken, so it turns to shift. And this, right? That is how I see it. And then I think which one is the last one? So once I draw that one, I take them out. The reason why I will always have this B under, sometimes you can even see B1, B2, B3. All right. So if in the synthetic, especially in the lower time frame, you start seeing B1, B2, B3. The reason for that is when the market is in motion. For example, if I was going to cash this retracement buy, for any reason, let's say I was going to cash this retracement buy for any reason, and let's say after my analysis, I see that this is where I expect a retracement for. Let's say, for example, I expect a retracement from here, right? After this break of structure, if I was going to enter this trade, I will have this B1, B2, B3. And those places that I have B1, B2, is going to tell me that this is a reaction. So this box is a reaction, right? Reaction 1, reaction 2. And somebody can tell you that this is order flow. If you have studied order flow before, you understand what I'm saying. So reaction 1, reaction 2. So if I have B1, B2, and this is the final reaction, this one, right? Actually, let me use the whole of this as the final reaction. So this is the order flow. So this is the 1, 2, and 3. That is the order flow. So these are the places that I'm going to expect a reaction from, right? When the market is going back up, you will notice that if the market is trending, there is always a place where it reacts to above. So for example, look, if it's going up, it has a reaction, and that reaction always happen after a break, right? You see it? It happen after a break. So when the market is coming there, or even though the market is going to take it out, it will definitely react to it. And that's why you see me entering a trade with confidence, because I know that even though I'm going to lose out on that trade, it should at least give me enough room to break even. You know, some people just enter trades and they get stuck in everlasting drawdowns. You don't see them getting the opportunity to get out of a losing trade. That's because they entered at the wrong area. You understand? So if you get stuck in a losing trade in a long area, you will see that it doesn't even give you an opportunity to get out. But in my own case, there is a way you enter a trade that even though the trade is going to violate you, because you are entering from a good order flow or reaction point, you are going to get something like this. For example, let's say I was wrong and I expected the market to start going. Let's say I entered here, right? And I get a good entry. At least it should give me, okay, for me, I know for a fact that if I was going to enter a trade here, it's going to definitely be somewhere around here. So it should definitely give me some good enough move, right, before coming back. And I think we experienced that in yesterday's gold trade. If you were here during yesterday's gold live trade, you can attest to that when this thing happened. So even though this market did not respect us, let me show you. Even though this market did not give us what we wanted yesterday, right? You guys remember when we entered this trade, right? This particular one. So we entered this live yesterday, and we got to like a 1 to 2, right? We got to like a 1 to 2. Yeah, don't worry, let it be running. Today I'm not even interested in making money like that. I just want to get you guys the knowledge you need before you can follow me in the derive journey. Okay, I want to get you guys to understand what it means to get involved in the market. So let the buy run. I am not really concerned. So you notice that when we entered this trade yesterday on gold, even though we were wrong with the direction, at least the market gave us enough time to exit the market. And that is what happens when you get into the market the right time. And we also remember that as at yesterday, we were planning to buy. It's just that we changed our buyers because we felt like this low was going to be taken. And at this point, I told you, we got our break even. After this area broke, we took our trade to break even. I only adjusted it to above this one because the high was looking valid, and then I lost a little. So even as at that, if I was supposed to lose $100 a year, by this alone, I know for a fact that for this market coming beyond this area, I would rather secure, like a little loss than the full loss. And I can now use the remaining of my percentage loss to face the next trade. So those who were here yesterday will understand what I'm talking about. So let's get back to what we're saying. So if you enter your trade in if you enter your trade in a discounted region, you are definitely going to have a good enough chance. So for example, this has already given you a 1 to 3. So if it's coming back against you, you should already know that you are in the wrong direction and you should get out, right? You should get out of the trade, and that will be okay. So that is the point for having all these rules and all these things going on, right? All right, so let's get back to it. So that is the reason why you need to have a precision. So now I don't need to draw a hand. I was saying this thing before that I don't like making my charts messy. So I did not draw this box before. I drew it just to explain something to you guys, the order flow and where to expect a reaction from. So even though you are looking to enter a trade, you should not be entering a sell here. That is foolish. You should not be entering a trade, a sell here when the market is down here. You should always wait for like a retracement, even like that. That's even if you want to get involved into this area. And if you follow all the analysis that we have done, you will even know that this first trade is not the right one. And that is how you can get a precise entry that can help you to be able to get out early when you are in the wrong direction. Because remember, your analysis can be good. Your analysis can be A1, but the market has another mission in mind. Remember, you are not the driver, you are only the passenger. You can only adapt, right? I keep saying it, I keep repeating it. So now that we have that setting, it is after me, I want to be interested in the sell only when the market have taken my liquidity, the internal liquidity. So so let me remove all this. You understand the concept of order flow and internal structure now, right? That guy that I'm answering, you understand how internal structure is, right? So once the market has like a goal in mind, let's say it wants to break this structure, everything that it forms internally, those are what you regard as internal structure. Oh wow, thanks so much, brother. To be honest, I don't know what that means. I don't know what League B3 means, but I kind of feel like that is a good thing. So thank you so much. Thank you so much for all the likes. Also, thank you for promoting the live, and I hope that you are getting value from it. I'm sorry if I'm beating around the bush for too long, but it's better to waste enough time and get good value. Okay, it's better to waste enough time but get good value than to rush over and get you confused even more. So please bear with me if I'm spending too much time and I'm explaining too long. Okay, so yeah, it is called counter trend or a retracement trend. That's true. So if I want to get, because sometimes yesterday I caught a counter buy, something like this, I could have caught this one, and that is how I will know that when this market is rejecting, I don't need to worry, because I know that I'm targeting this internal liquidity. So somebody like me, as this whole thing is happening, why that liquidity is not taking, I'm just laughing. I'm sitting on my, sometimes I will even be entering more position. And that is why in synthetic, you can actually like scale into trades very well. All right. So I want to believe that is gotten. So I got my 50% and I got the market take liquidity. The next thing now is to look for an internal shift. And to that guy, sorry, I keep forgetting the name. The person that asked about internal liquidity, if you are see here is it. This is where your lower time frame analysis now come into play. Fees, that's you. This is where your internal structure gets in. As I promised, I was going to get into it. Yeah, so this is where your internal structure gets in. Now that you know that officially you are going for liquidity, you now go down to like 5 minutes from the 1 hour. You can go down to 15 minutes if you want. If you go down to 5 minutes and it's looking confusing, switch back to 15 minutes. But oftentimes, I will just go down to 5 minutes. You understand? Because I already know. At this point, you already know what you are expecting, right? You already know what you are expecting. The liquidity has been taken. You are looking for an internal shift. And even though my original internal shift, oftentimes I like for it to at least take the last low, something like this, right? I would like my shift to happen after this low is taken. You cannot deny the fact that after this was broken, right? After this high was broken, there was a retracement, all right? A little retracement that took its own internal liquidity, right? There is a liquidity taken behind here, which means, look, let me zoom in because there is a lesson to learn here. This retracement, this pullback, this particular pullback, right? And this pullback are two different types of pullback. This one did not take any liquidity. This one took internal liquidity. Look, it took internal liquidity. Okay, you can see it there. So this one can be confirmed as a retracement. It's just one of those fake out retracements, right? It's just one of those retracements that make people who are buying or selling here feel like they are good, and it takes them out, Abby. So it has an internal takeout before going on. So I can now consider this as my internal. This is where I will use CH, which many of you will regard as change of character, right? It has changed character. Now that it has changed character because you paid attention to what you were seeing here, it changed character based on going below this one. You know that this move has changed character. Even though it is now doing something crazy now, look, remember our analysis is always a retracement to 50%. So now we'll name this one as a 50%. So let me label this as 50%, right? And then I can delete this one so that it doesn't complicate my chart. This is 50%. What liquidity do you see? I have liquidity 1 here, which was the change of character, and then liquidity 2 here, which is the premium one, right? The one that is even better. What do you see after the liquidity was taken? Of course, this area broke structure to the upside, so you can call it B, right? And this you can call PT. PL, sorry, PL. So if you see PL on my chart, it is protected low, right? This was the protected low. But remember, this is also a protected low because it completes the cycle. A complete cycle is when the market clears liquidity before moving forward, especially when it is outside the range. You understand? When it is outside the range, it takes liquidity before going up. That makes it a complete cycle. So we can pay attention to this place instead of this place as the protected low. Though this should have been the original protected low. If all we had was reactions like this, I would not have called this a change of character to take a trade. I would have waited until this low was violated. So in this case now, I guess we'll just call this one is no longer protected low. So let's name this area protected low. But since it's already our change of character, let's leave it at that. All right. So you get the two difference, right? This pullback is not a complete reaction because it did not take liquidity before going. This one, however, it is outside the range. That's one. Though it never retraced down to 50%, at least it did its complete cycle. Complete cycle meaning it took liquidity before moving forward, which means a market should respect it originally. And as you can see again, it created its own internal liquidity right here, right? So if this market really wanted to keep going up, it could have just simply, pull back to inside this, taking its own liquidity here, right? And then maybe do something like this and, continue going forward if this market wants to keep going. Because this is a complete cycle, it has liquidity, it has everything that the market would want to continue going back up. The fact that it violated it, it means that the market have shifted. And since we are inside the internal structure, I will call that one change of character. Original shift is like the one that breaks out of the entire zone completely. So original shift for me will be that. So let me delete these things. You can see that I did not draw this box, but in my head, I have the picture painted in my head that this is what I'm looking at. That is going to be helping you. And this is our first sign that the market is now, respecting what we are demanding of the market. We are asking the market to take liquidity. We are expecting the market to, from our previous experience, we're expecting the market to from here and go. Now, what do I do? If this is a change of character, let's take all these guys out, right? They have done their job. This was liquidity. So I annotate all my lines so that you know what they are. So if this was what it is, it means originally after change of character, I expect this also to do what we normally expect every reaction to do, right? From here to here. So this is 50%. It broke below 50%, and then it took liquidity. So what do you expect after you see a candlestick like this? We know that it's coming from a place of fulfillment. It has fulfilled his dream. It has taken liquidity. So person like me will not be looking for this trade to go ahead of this. And if you were in that trade that we took yesterday on gold, you will understand that I did that same thing. I took a buy up to sell. If you understand what you are targeting, for me, that would be this. Because I know that we are coming from a liquidity. Many people are going to miss this as structure change. Many people are going to be waiting for this one to be their structure change. And they probably are going to miss out on the trade. So if me, I am in this trade, I have a trade here. I'm targeting just this place because I know that we are coming from a liquidity grab and everything. So are you guys following so far? If there are any questions, please feel free to ask because it will help me to explain better, okay? Please load me with questions. I am here to answer. Don't worry, I'm not scared. And don't think that I will take you as you don't understand or you. No, please ask the questions because that's how I learn. What strategy is this? This is price action. This is my personal strategy. I cannot attribute this to anybody. I can tell you that this is born out of many strategies put together on my own. I learned from many people, but this particular explanation that I'm giving to you now, these are all born out of my experience. You understand? But these experiences came from what other strategies have explained. For example, in SMC will tell you that fair value gap. You can see a fair value gap here, right? You can see a fair value gap here. This is what an SMC trader is always looking for. So an SMC trader will probably be looking for this to take a sell, right? A support and resistance trader will tell you that I have a support here, right? So there's a rejection before breakdown, right? So a support and resistance trader will have his line like this. We'll be waiting for a sell from here. A trend line trader will tell you that, okay, I was in this trend going up, it broke, so I'm waiting for a retest to go down. You understand? So all the various type of strategies work. It's just you understanding what they are talking about and knowing how to use it, okay? So you can use all this information to know what is happening and when to get out of the market. So having all this information at your fingertip or having all this analysis done will help you to understand and how to know how to navigate what is happening on the chart. So it is very, very necessary. So moving on. Oh boy, to the talk no easy. God damn. Anyways, you get the point now, right? So that is the reason why if I have this counter trend trade, my target would definitely be here, because I know that we are coming from a liquidity, we are coming from like a fulfillment. So this is what we should have. At this point, the moment the market gets into, now, after this is done, all this was to get a retracement trade if necessary, right? Simply because I saw this candle and it looks good. And that's on the 15 minutes. We're still going to go down, okay? I can now delete all the unnecessary annotations that I have on my screen and leave the ones that I need. So now, this is when I will be getting involved in a trade. You see, after that red candle, I have my conviction that I can have my stop loss above this area, give it a little gap above, all right? Because sometimes V75, entering a trade from a place like this will be my target. So now I'll enter this trade here. Now, this one was a little bit troublesome, yes. And you see that this thing happens a lot. It happens quite a lot, right? It keep repeating the same thing, right? Look, came below liquidity, give you a sign, buy back up, right? Give you a sign, buy back up. You know, it's happening like that. It's now left for you to understand which one is good to take. So you see, if you are trading without an analysis, you would probably be entering this trade too, or you probably be entering many other trades that you see on chart. I probably will not take this one. Anything that makes this market goes above this level now in this time frame, it means the market still has, like, maybe it has not done what it wants to do. Okay, so just let it cook. Allow it to do what you want to do and then get involved. You have gotten into a trade, just let it cook. Just let it do what it wants to do. Okay, so let me delete that. So originally for this trade down, I would have been in here. Based on the 15 minutes, I would have get involved in this trade. And you can see that it gave me at least 1 to 2.5. This is the area where you would have secured some profit, which is nice because this is 1 to 2.6. This is what people are looking for out there. You just got it. Now, if the market decides to play around, you wait for it. This is another form of entry for me personally. If I now go down to the lower time frame, especially since this trade is still valid until this high is violated, pay attention. Look at it. It was never violated. Look, it never touched it. It was never violated. So, and even if it touched it and it's like a week and then there is a change of structure, so far the entire high is not yet violated, the trade is still valid. So you enter the first trade, you are too early in the game. The driver is telling you, I want to go your way, but you know what? I cannot move from Lagos to Abuja with only 5 passengers. I will need to go back and take more passengers. Those are the people who could not enter at first or so, or the new liquidity. And this is why you should get out when the trade is coming back to your entry, right? Get out and watch for what he's doing. Because now that it doesn't have enough people, there's chance that it's going to go above you. And what does it do? It went above this area. So that is why when you are in a trade like this, you either decide to reduce your stop loss to that area or you just take it to break even. You understand? Because if your stop loss for this trade is here and it's not here, if it's not here and your target, your stop loss is above this candle, then you're dead. All right. So it took them out, it took everybody out, and then maybe at this point it gives you this final candle. I probably will be getting in on this last candle because remember, I probably would have made attempts to enter this trade 3 places. So the first will be this one. The first will definitely be this one. It gave me this. See how good it is and how precise it is. The second one now, if you go internally, you see this break of structure. You see this thing happening here, right? So the second sign that it gave would probably be this one, right? So this, and all of this trade, I'm holding it like this. The stop loss is always going to be above. So any trade that I'm entering here, the stop loss is always going to be above my, this is a protected high now, right? So that's the protected high. My stop loss is always going to be like maybe a pip or two above the protected high. So any balance that I'm using to trade should definitely be enough to cover that protected high if you want to be safe. So if you enter the first trade and it gives you a break of structure, internal structure that have taken liquidity, another person could be seeing this as a break of structure. So don't fight the market. It has gotten beyond this liquidity. You should take some partials and wash. You understand? We did not take partials yesterday and we paid the price, right? The market came back. It gave you a second entry. What do you see? It also came to below liquidity and gave you like a 1 to 2.3 first before going back up again. So at this point again, this is another break-even trade. If the market has given me a break of structure in my favor, then anything that invalidates that break of structure, I am not interested. So if it is coming back and is going above this one, I'm not going to say it's going to do retest. Let it do the retest, and when it has done the retest and is ready to go, I will then follow again. You understand? I don't mind if, let's say, you see this, or this was the original entry, right? If the next entry is going to be like this just because I had to wait, I will wait. You understand? It's better to wait like that. You understand? If the next trade is going to look like this, the first one was precise. The next one now, because you have to, wait for that new story. If it's going to be like this, I will wait and I will enter that one. It's better safe than sorry. And now that it's coming back again, it's coming back to your entry. Yes, I'm going to set it to break even. I will only enter again when I see a very bearish intentional candle like this. I have made mention of this intentional candle a lot of time. It is intentional candle because it has a target. Intentional meaning it is bearish. It violates all the other candles that are around. It's like saying, okay, you guys are playing, I'm the boss. All right. That candle that is going to prove, for example, look at all these places. You will see it. This is an intentional candle. What happened after the intentional candle? Look, very bold. The next thing you see, big move. Look at this one, too, intentional candle. The next thing you see after a truly intentional candle is a big move. So I always wait to see the end of that candle before I go in. All right. And I like to see it as a bold candle that is in the opposition. But anyways, you get the point. It has to be bold for me to follow. And once it closes, the moment it is closing, I'm entering my trade. Sometimes, depending on how volatile that candle looks, if you are waiting for it to come back, you guys will notice, or you will agree that, like, how many trades have we taken together? We have taken like four trades together, right? And 3 out of those trades, the moment we enter, it start going. That's because you are the last passenger. If you are the last passenger, then there is nothing that the trade should be going back to look for again. And sometimes you can see something like this. When a new candle opens, the first thing you expect is for it to create a wick, right? Sometimes that wick can go all the way to up around this base that it has broken before coming down. So what I do is, once you have your intentional candle, just know that the range at which the intentional candle is coming from, the market should not break above that intentional range anymore. So for example, this is what I'm talking about. This pullback can do as much as go into this area before coming back, but it should not go above this one. If it goes above this one, it's kind of telling you that it's violating the trade already. Because now you are having two things. You are having your range to battle with, which is this one, your protected high to battle with. And then you are having a support and resistance break. So you see, it broke below resistance, so it should now be support. So if this market is coming, you expect, like, the best it should do should have a retracement and then it drop back down. All right. So that is why I can feel free to open my trade immediately after the intentional candle closes, because oftentimes it does something like this where it never pulls back to your entry before going your way. And now if we go down to the 5 minutes, you see what I'm talking about. I'm sure we get more precise entry on the 5 minutes. So for this particular one, you can see it is opposing another intentional candle, which explains why you can see rejection that even went above it. Again, an intentional candle is like a runoff candle. It should actually violate the other candles. It should really prove to you, say, oh, more, I ready for business. You understand? You to clear those areas. So, and that is why we had it on that 5 minute. But you can get it more precise in this 5 minute time frame or something. You can even go down to the 1 minute and you can see a more precise. Like I entered on the 1 minute with the V75. So now, if you notice something from the beginning, I walked my way down from the higher time frame, and the more I am moving, it's like trying to narrow down your trade idea to one particular point. Like I think that is the original definition of sniping. When you talk about sniper entries, a lot of people will be thinking it is how precise your entry is. You just touch your entry and it started going. A lot of people misunderstand sniper entry for being how precise your entry is, when actually sniper entry is like trying to pinpoint it down to that particular point where you feel like it is completely safe. You have all the things that you need in your favor, and you know that if you violate, then you shouldn't be in the trade at that particular point. Remember, as you are entering this trade here, you are entering because of what you have, the information that you have here, right? You're entering because of the information that you have here. It doesn't mean that the SMC trader who has his own target or his eyes above this place, that this person, today might be the SMC trader's day, and other block is what the market is going after. And after your intentional candle, just know that you have risked some certain percentage of your account here, but you risk that certain percentage of your account with an analysis. You risk it with a good analysis. You have done your due diligence. You knew exactly exactly what you are doing before you did what you did, right? So you should be okay with yourself, even though the market is giving you shit. You understand? Even though the market is not giving you anything serious, you should be proud of yourself that you did everything. So if this trade were to go against you, it's not your fault. You are just not the driver. You just did what the market did gave you, but then it didn't work out at that point. Plus, again, there is another liquidity up here. So, I mean, why should you be mad that your own analysis is bad when we just agreed that every analysis is good? You understand? SMC trader still have his own analysis here. So, must you always win? You should not always win. So, that is why when you have your trade, have the reason for entry and have the reason for your target. So, if I was to be in this trade now, first targets or the overall target will be here. Of course, I'm also going to treat this one too as like a form of break of structure to the odds upside, even though I know for a fact that this thing is a retracement move. So maybe because of that, you can take your first profits under the liquidity. Remember, if you're going to take this trade, this is where you are going to take your trade from, right? So when you get to this area, you should at least secure some profit at, I mean, this is 1 to 3.8. This is almost 1 to 4. So say you have like a huge position inside, you can take some profits and then watch to see what will happen. But the overall target will be for this area here. And what do you notice after a structure is broken? Usually the structure gets broken, you call it a shift. What happens after a structure is broken is it often takes more liquidity to the downside. It generates more liquidity, it creates more liquidity by breaking more structure to the downside. It keeps breaking to the downside, and after a while, when it's done taking all the liquidity, or when it's not seeing more liquidity to take, that is when it will now start the original retracement. So now that you have a complete trade, what is your next option? Your next option will be this. Now we are done with this trade. This trade is complete, right? Your next option will be, has it started retracement? How do you know that it's starting retracement? When the market is approaching a break of structure, when it's approaching any break of structure. Slide J, hey, you're welcome, you're welcome, you're welcome. Everyone, thank you all for the likes. Thank you all for the support and everything. And I hope that you are gaining or you are having something from this. So please keep liking, keep following, and keep promoting this so that we can extend it to a lot of people. I said it before, the reason why I'm doing this is because this is the one thing that I have always wished I have when I was learning, because I took a lot of time learning Forex, making a lot of mistakes because I didn't have like someone who we can actually, discuss, and I'll have, it's another thing understanding the thought process of that person. Oftentimes it is best to stay out of reversal, but you won't lie, sometimes there is a very large extension and you know that definitely there is going to be a reversal. But how do you spot a reversal? Now, if you have understood everything that I've been teaching you since, then then you know that there is something that we call internal structure. All right, internal structure, especially when you go down to the lower time frame. So let me go down to the 5 minutes right now. So you now ask yourself, before there was a shift, what structure were you following internally? With relation to this one, this is a protected high. So this is a structural break. This is a structural break. It is forming structure, and even inside this particular structure. So externally, so this high, it is external to this one. This is internal to this one. Same way, this is internal to that one, right? So this is internal to this one. Inside the internal structure, I will also pay attention. So now, what I will be doing at that point is, as the market is breaking structure to the downside and I'm looking for a place to get in, I will be drawing my lines above and below internals, right? So there is a break of structure to the downside here. So originally that makes this high a protected high, okay? Remember, now we are in the 1 minute time frame. This makes this high a protected high. So I want to see a violation of my internal protected high. You understand? V751X, yeah, thank you. So I want to see a violation of my internal structure high or low, depending on what direction you are looking at the market from. So I want to see an internal violation of my protected high. So if this is a protected high, it means it should not be taken out. And after taking it out, I hope to see that it does not mitigate anything yet. There is a gap to still fill. So for example, if this was a break of structure that did something like this, look, a break structure, and it went as high as mitigating something around this area, before coming down, I will not pay attention to it because it is coming from a fulfillment. What you expect is that it goes to mitigate the previous structure. So when the internal breaks, what you expect is that at least the next movement is for this to happen. Go and mitigate, and you can see that reaction happened there. Everything that you see in the market is mechanical. Okay. So let me explain. I said I caught a reversal. How to spot a reversal, right? Before your shift, pay attention to what happened before your shift. Remember, from the higher time frame, we agreed that before your shift, what is the internal structure that was being followed? So this is the structures that you have been seeing: lower low, lower low, lower low, lower high, lower low, lower high, right? So you'll be paying attention to the internal structure. And again, this structure here, if I go on the 1 minute, you notice that this move did not just fly, right? It did not just go like that. It did something. It went up, down, up, and finally break, then retest, and it goes back. And this is what I keep saying about being mechanical. If I expand this thing now, you see that it's just left for you to understand what you are looking for and what you should see before you get involved in the market. So in this case, if I was following this trade and I was following this thing going up, it was following an internal structure. An internal structure got violated at this point. So let me remove this line and let me do the analysis here so that you see. So internally, we saw this coming. We have this and we have this protected low. The moment this protected low was violated by that black candle that you saw there, was violated by that candle that you saw there, the next thing you should be looking for is a retest. And if you are looking for a retest, what do? The same thing that you did on the higher time frame. Bring it to the lower time frame. Pull out your fib level. Where's your 50%? This is your 50%. Let's write 50% there. Let me take this one out. So it's just rinse, repeat, rinse, repeat. Take what you did on the higher time frame, bring it down to the lower time frame, and then continue. After the 50%, what do you expect? Liquidity. It takes liquidity. After liquidity, you look for an intentional candle. So if I was to go to, like, let's say 1 minute or 2 minutes time frame inside this internal structure, still on the internal structure, after we did this structure break, that is when we go above here, and then we got this very intentional candle, right? So this would have been your entry for this trade because you were paying attention to what is happening internally. The moment it breaks, you have a new goal. The new goal is to go and take the next liquidity, right? So this would have been another good trade. Internal structure is just like saying what you are seeing outside, take it inside of that particular price action and use it too on the lower time frame. And that is how you get movement from point A to point B. So it's understandable, right? Was that clear enough? All right, so that's what I mean by internal structure. Now, if I zoom out of this one and I go to the 5 minutes, the 5 minutes is any structure you see on the 5 minutes is an internal structure to the 15 minutes. Any structure you see on the 15 minutes is an internal structure to the 30 minutes if possible, or to the 1 hour. So what you are seeing on the 5 minutes might be looking bold, but to the 1 hour, that is an internal movement. And that, if you are paying attention to those internal structure, that is how you get when to get into a trade. You understand? So we'll call this one. Now that we are done with this trade, mission is accomplished, right? Mission is accomplished. This is our target. The next thing you want to do is wait for when the market will start its retracement. So for example, let me use this last trade as an example. So if I pull out my Fibonacci and I draw it down to this level, let's say this is where we have now. Where is our 50%? I now draw my line of 50%. And then I label it because I always like to do it like that. And then I delete this just so I don't get so much. After 50%, what is that rule of thumb? Liquidity. Where is the last liquidity you can see? Let me use this one for example. So this is the visible last liquidity that I can see, right? You see, it went above and took all those liquidity, right? Now, after liquidity, what are you waiting for? You're looking for an intentional candle. Remember, on the 15 minutes, we could see this whole thing as like 2 candles or 3 candles. So maybe it will be weak, and then one final candle. Now that you are on the 5 minutes, you are now in a lower time frame. All right, you're now in a lower time frame. This is where you want to see a structural violation, not just an intentional candle anymore. You need to first see a structural violation, which is something like this. You see this as a break of structure. You're expecting this low to be respected, right? Ideally, this is what you would expect, right? So if you want to pay attention to just, I zoomed in so that you see what I'm talking about. If you want to pay attention to just this reaction, right? This reaction here. So this is a break of structure to the upside. Ideally, this is what you would expect, right? From here to here, 50%. So you're looking for liquidity around here, and you should be looking for the last one, an intentional candle, right? To buy back up, right? And then your stop loss should be like that. So if this was supposed to be a complete cycle, it means this low is protected, right? Protected, PL. So this is my protected low. The moment a protected point, either low or high, is violated, that is a sign that we are heading to another direction. And if you pay attention to what I said about internal structure, structure is anything that breaks above a new structure, right? And your internal structure is violated to the downside. What should you now be looking for? You look for that move that violates the internal structure. Remember, already we are not here. We are not looking for buys here, right? We are not looking for buys because we already know that our market has tapped into where we should be expecting a sell. So that alone have already saved you from, trying to get into a rush buy and getting liquidated, right? Because we know we are coming from a liquidity area. The market has achieved its goal. This is the point where I say the driver's bus suppose don't full. You don't chop all the liquidity where they are available. So at this point, you suppose don't pick all the passengers where you want. So it's time for us to go. Yes, I know it's time for us to go, but the driver never say let's go. So I will wait. And this is what I will now do. You wait for a violation. The market now has to print a violation for you because we are now in the internal structure. At this point now, you are not looking for just intentional candles, right? You are waiting for a proper breaks, because if you are looking for intentional candle, you would have taken this as an intentional candle, like a bold candle, to take a trade, right? This is what you would have been doing. OMG, FGG, with this, your strategy is sweet. You get that, but you don't get the idea. So you see now, but ideally, if you're supposed to be paying attention to only intentional candle, this might be what you do, right? But the reason why it is not right is because you are trading out of a place where you don't have any other, structure to put your stop loss above. I mean, if you are entering based on this candle, are you just going to have your stop loss above the range, or you are going to have your stop loss all the way up to the top? You don't have a structure to put your stop loss above yet, so you wait for a structure to form. So that structure will be breaking below, violating a structure, like what you call change of character. So now, the moment this thing is violated, you now edit it and change it to CH, which is your change of character or shift. Now, after your shift, what do you expect? You expect a retracement. First to 50% and at least one liquidity taken. This is my 50%, and then this is my liquidity. So any intentional candle that I now see inside of this place, I can now enter. So here, this will be your intentional candle, right? This one, this bold 5 minutes. Then you can now enter with that one as that candle close, enter, and your stop loss is where. So now you have both your intentional candle to contend with, even though the market wants to be stupid and go up. You have your intentional candle to contend with, and also you have this structure, this newly formed structure to go with. The reason why your stop loss should be above this area, usually I don't expect the market to go beyond the intentional candle that I'm talking about. But then, since we still have like a second liquidity sitting above here, if you're paying attention to it, then it is best you have your stop loss above the entire range that you have created. How do I place my Fibonacci? My Fibonacci is placed like this. So if I'm considering a shift, where is the high or low that created the shift? This is the high that created the shift, right? And this is the last final point that the shift went to before starting. So if the market is if the market is going into my 50%, I would do, if it's breaking structure internally towards my where I expect it to get to, I will now draw my fib from the top of the week. You understand? From the top of the week to the last top of the second week. That is how I draw my Fibonacci. And you can see that I have addicted my Fibonacci to only show 1, 0, and 50. That's because I'm only interested in the 50%. A lot of people will tell you that you should wait for it to reverse back to the 6.8, but I think that is just complicating things too much. So I'll just wait for it to reverse back to the 50%, and then I'll delete that. Once I label it, I will delete that. I'll draw that there just to signify where my 50% is. The 50% is to tell me that the market have sufficiently retraced. A sufficient retracement will be a retracement beyond the 50%. But then the added confirmation that we now have in our own trading strategy is that we also want it to go and take liquidity, which SMC people will understand what I'm talking about, because it's now hunting liquidity. And I've already explained to you guys that liquidity, in my own opinion, is passengers, right? Until the bus is full, you don't expect the driver to go. So it has to go and take everybody. So let's just call this one cycling back. It cycles back and go and take the last passenger that you can see. If it takes the last passenger, since it has gotten an intention to go down because of the shift was what gave it out that it wants to go down. So you mean the new direction is a down. So after it gets into my liquidity, I now wait for the intentional candle. So I'm making my entries immediately the intentional candle closes. Because remember, on the 15 minutes when I was analyzing the other time, I told you something that after the intentional candle, sometimes you should expect a pullback, right? Before going down, but it shouldn't go above, usually it should not go above the intentional candle unless there is another liquidity that is attracted to. It should have a pullback, but the pullback should not go above the intentional candle. Because why we call it intentional candle is because it proves to every other person that there is a strongest candle in the house. So if I'm the strongest person in the house, you should not violate me, right? I am the violator. You shouldn't violate me. So after that intentional candle, I immediately open my trade. And the reason why I open it after immediately it close is because sometimes it doesn't just come back. Sometimes it is so strong, the volume is so strong that immediately to just start going. Let's use this very bold candle, for example. You see how it violated 1, 2, 3, 4? That is telling you that, yes, I am the boss, right? It's trying to prove to you that I am very intentional. I am going in a direction. And you can see that even though the next candle did a pullback, it didn't. If you were waiting for it to go back to this blue one before going down, you would have missed out on this trade, right? So I don't want to miss out, and I've done all my due diligence, and I think I am okay to enter this trade here. And I know that even though it's going to pull back, it shouldn't pull back behind this range, right? So I can just take my trade there. It doesn't matter if you play around, and that is what you saw here. So I enter my trade here. The stop loss is above the range. Sorry, the stop loss is way above because again, like we said, this is sec liquidity 2. You can name this one liquidity dash 2. So if I see 2 liquidity in my zone, I expect that any of this can happen, but I will not just be too except the market is not giving me entry signals. I will not be too rigid. If I see a confirmation to enter a trade, I will enter on the first one. So far, one liquidity has been taken after your 50%, then you are good to go. But just make sure that your trade that you are opening, if you are seeing another liquidity above it, just make sure that your stop loss will cover the entire range. And that is how you get all these things. And if you enter that trade from there, since this is a retracement trade, you can easily say it's going to go down, right? It's going to go down to this. Now, and this is why I took this trade yesterday. Unlike these other ones that just retrace and go, there is a difference between this one. Though this went above 50%, if you look at the price action, you can also call this whole thing, because it broke above not just 1, not just 2, not just 3. You can still call this one now a shift, right? You can call this one a shift or a break of structure to the other side, which means there is every reason for the market to at least respect the low after taking this liquidity, even though it's not going to keep going. So far, there is this thing here. I expect some reaction, and if I see a good entry, I should partake in it, right? And that is why when the market was below here, I just paid attention to the entire structure. And you can see everything that I just explained to you now. You can see it on my screen here. So there is the shift internally that did not mitigate anything. If this thing wanted to be a complete shift, it would have at least come to this high, right? It didn't come to that. It never mitigated that. It shifted, and then if it has shifted to this direction and it has yet to mitigate anything, if it has shifted and it has given you how I got this end. So doing that analysis, you can see that liquidity was taken behind, liquidity was taken below, liquidity was taken below, makes or confirms a zone for me. And then there is a shift. And what do? I pull out my Fib level. I mark out my 50%, right? I mark out my 50%, so deleting that Fib level. And then I wait for the market to go below at least 1. You see, I wait for the market to go below at least 1 liquidity, and this is the only liquidity I can see, right? And after that liquidity, the next thing is the intentional candle. If I was only looking at the 5-minute time frame, my intentional candle would be this one. My intentional candle would have been this one, because remember what I told you again, intentional candle, but then if it is facing a rejection, there is a high chance that this thing is going to happen. I said that like I can say I've said that like 10 times already since you guys have started following me. So if an intentional candle is coming right after a very bearish candle, wait for further confirmation. And that further confirmation is this rejection that failed to break below it. And then the next candle becoming an intentional candle. So now I can enter this trade here. My stop loss, of course, covering this one. Of course, you are going to enter the trade at a worse position, but then you are safe. But then if you go down to the 1 minute now, I think you see clearer there why or how I was able to get a more precise entry. I waited for this liquidity to be taken, and then I got this very intentional candle on the 1 minute. I think it was this first one. I got in on that candle. No, actually, it was the second one. So the first one was not looking too good for me, but the second one gave it out for me. So I entered on the second one, on that second candle. And you can see what I'm talking about, intentional candle, right? If anything is going to play around, it's not going to go below it. So the next thing I make sure the balance I had in my account was able to cover this low, right? And then you see what we said about that 5 minutes on, because the 5-minute candle was pretty intentional. Like the second one was very bold, which is signifying selling pressure. The next one came, rejected, and then this was the start of the last one. So if you are not in here, you could have even scaled in here, because you could have even scaled in here, right? More positions here. And this is how I am able to get these precise entries that I get. Look at this. Look at this. You're seeing it for yourself. I entered this trade here, right? But hold on, look, 6.55. Look at how many positions that I have on, right? So I can layer in just because I know I'm entering precise. You can see this is the entry. Look at exactly what I just told you guys, right? This is the entry and I'm expecting it to go. So I can enter a lot of position on this one. And because it is synthetic, it's not like Forex where your leverage needs to be very, very big, right? You don't need big leverage here because they don't price it as like saying one standard lot is 100k dollars. No, it is synthetic, which means you can open plenty position. So please let me know, are you guys following so far? I think I have explained this thing with like 3 places, and anyone who should get it should have it by now. But if you have any questions, this are the time that the questions should come in. So in case you have been looking at me and you have been thinking, what is this boy doing? Is this luck? Is this luck? No, it is not luck. This is exactly my thought process and how I approach the market. And I hope you guys now know how I analyze. So any questions? So liquidity should be one, above 50% of your move, right? Above 50% of your entire move, right? And then there are always like 3 order flows inside of there are multiple order flows. There's not a number to it, but oftentimes it's like 3. So the first order flow that I've explained this thing before, first order flow that we can see here is this one. This reaction is the first order flow, followed by the second one, and then this one has a gap, and that is why I said I will not pay attention to this one, because this one has a gap from the previous one. I see how this one is connecting with this one, and then this one is connecting with this one. So they should be connected. Anyone with a gap will probably be taken out. I've seen it happen too many times to be paying attention to it. So above every of this reaction is a liquidity. So you can set since there's one here, you can have one here. So you can consider this one as first liquidity, second liquidity. Above every of them is a liquidity. So 1. So you could either have a trade here that respects here, or a trade here. So there are 2 trades that are possible. There are 2 places that you can possibly get a trade from here. So there is 1, 2, and since the overall is still at the top, you can probably get into 3. So these are the 3 points that I will be interested in entering a trade if I see a reaction. Those are the liquidities. Okay, now that I have that in mind, I can stretch that out and extend them to the right of my screen, right? And then I can just go back to like a higher time frame, because that's a long journey and I'm hoping that the market gets into it. So this is the 3 places I have. You will always see a reaction. No, this is synthetic. This is V75 1X. You will always see a reaction above every liquidity. What do you see? Look at this reaction. And that is why I say, even if you ended up taking a trade, a wrong trade, right, but in the right place, you always have an opportunity to get out, because there is a lot of liquidity driving the market there, right? There's a lot of liquidity pushing the market. They are trying to reject the market. So let's say I got into this trade because of this break of structure, right? This internal break of structure, and I'm looking to sell here, and then I got this intentional candle and I enter a trade here. You see, it went down a lot, or enough, because it broke structure. It went down enough for me to at least secure or put my trade to break even. This might not be the best one, but you see it there. So we got this one. The next thing that we want is to have a break of structure, right? This is a break of structure, and these are the cases where waiting for final confirmation could be a problem. Any entry for us now? No, there's no entry. There's no entry now. This is all just a practical section. There's no entry. There's no entry. There's no entry. This is just me explaining. So any more question? Because I'm about to go to end the live. I'm about to rest a bit. Any other question? And I hope you people learn a lot from technical analysis today. So these are the basics, and this is how I approach my own technical analysis. Okay, and that is why you have all these plenty lines on my screen every time. They are not there for nothing. They are there for a reason. That is why at the end of a trading day, you often see my chart looking like this, because they are all speaking a story. After price takes the first liquidity, do you want to sell? Yeah, if the price takes the first liquidity, like it happened here, right? You see that it did take liquidity here, but it never went into that area. But there was a condition for that sell. The internal structure shifted, right? The internal structure shifted, and it gave all that I needed for the trade, and that is why I was able to get in. Unlike this one here, it shifts, but it never gave us an entry. So this is one of those ones that you just missed out on. Yeah, of course, I'll post the video. You want to sell after the price take liquidity? Do you want to sell? What liquidity? This one, right? So, like I just explained, yes, I would be interested in sales if this reaction was maybe like coming from somewhere around here, right? But now that is that, if we're going to take this trade, for example, if we're going to take a trade from here, our target originally will be this down here, right? So if our trade from here has a target down there and the target has already been achieved, the goal has already been achieved, right? The goal has already been achieved. It means this particular movement that you are seeing out here would have like another mission in mind. Okay, the mission could be this liquidity, yes, which means if I see this kind of full setup, this type of full break shift, liquidity it takes liquidity here. If I see this type of liquidity being taken out, shift happening, retracement to 50%, and then intentional count, definitely I will get involved in any area from here. But for now, it's just approaching it. But then again, you need to be careful, and the reason why you need to be careful is because the market has already, did what a break and retest to take out would do. Okay, so any more question? I think I've answered all the question I have here. Let me know that I was talking to people. You guys drop comments and let me know what you feel about today's class before we go. Please drop a comment to encourage me to know where I can do better or where I need to pay attention to next, because you might not see me explain it directly like this again in person. It's going to be me referring you to the YouTube video that I'm going to post. You might not see me explain technical analysis like this again in person, because that will be me repeating myself over and over again. So it's going to be posted on YouTube, and you guys can always but for now I think I am done, and since I'm very exhausted, I'm just going to, you can see that most of my explanation so far I am explaining with usual things that you see around you, like people, driver, this, that, and that. It's because I have related my trading strategy to my personal self, things that I experience in real life, so that if I'm seeing it on the chart, it's just like a walkthrough in the park for me. You understand? It's just like a walkthrough. It's like I'm living in the moment, that I know this script. I know what it's about to tell me. And oftentimes, I'm not going to be worried that it doesn't go my way, because I feel like if it doesn't tell me now, 9 out of 10 times, I probably am going to get it right. And even though I'm going to take a loss, because I have other things like risk management, which might be the next topic that I'm going to teach. Since I have things like that to back me up, I don't need to be afraid of taking any trade. You understand? If I see a trade and it ticks all my boxes, I am taking it. Any more questions? And thank you so much. Thank you for those who are telling me really nice. That's very, very good. Very impactful. Thank you, Gideon. I'm happy you learned. I just want to go and practice this weekend. You have really broken it down well. Thank you so much. I appreciate that. Thank you very much. You explained well. It is good information. That's other traders are selling for huge. Yeah, of course, of course. Okay, thank you very much. Thank you very much. Please, I'll text you. Yeah, exactly. Afiz, you can go ahead and text me. See you at 3 a.m. Jude, see you guys. I'll just end this one here now. Thank you very much for being here. Market is trying to run out from liquidity. Yeah, allow it to do what he wants to do. Okay, Jude is your port. All right. No problem. I'll look into it, guys. Thank you. Have a nice day. This particular one alone, give me almost $1. 0.8. Some betting pay. Yeah, I've collected 700 diamond. Mm. Okay, let me close this now. How do I stop this recording? How do I stop this now? Okay, and live stream 2 hour 38 minutes. God damn, I have to edit this.